Welcome to the Real Estate Reserve Podcast. I'm Jason Bound from Hard Money Bankers, and across from me, Ian Horowitz from Equity Warehouse. We're winding down. I don't know if we should say winding down or ramping up the end of the year, going into the last week of December before New Year's. And I think ramping up. I like that. I like that better than winding down because, hey, we're in this space to continue to grow. We've got a great topic and guest that Ian's going to introduce here in a second. We're going to be talking about the power of infinite banking geared towards real estate investors. It's a topic that I really enjoy, and full transparency, I understand about 90% of it. I'd like to be able to get to that 100% mark. I think a lot of people that are listening or watching this, first, if you're listening or watching, welcome. If you're a first-time viewer, or welcome back if you're a regular follower of us. But I do believe that most of the folks listening or watching, this is probably a very new topic for them, and your head might get, blown a little bit when you hear this. You're like, why is this the first time I'm listening or hearing about this? This topic, infinite banking, and that's what I'm going to say on that. Ian, hop in, and then we're going to introduce.
Yeah, and Jason, you did a good job for a long time. I understand 90% of it. I've implemented some policies. I still understand about 90% of it, but Karl and his team do a really good job of saying, hey, man, this is where you warehouse wealth. And I think if you read Nelson Nash and a few other things that we're going to talk about today, it'll help break it down. But guys, real quick, we are winding down the end of the year. You guys know we love doing these podcasts. We'll do a recap at some point early in the year of all the guests that we had and gone through. But if you guys get any value from this show or any other show, please share it or give us a 5-star or any sort of like or comment on Apple, iTunes, Spotify, YouTube, wherever the heck you watch this. Because we do this show for you guys. We do it for ourselves because we, topics like these, we get to learn and we get to share our experiences that we're doing in real time. But if you feel like someone's going to get value out of one of these episodes, please share it. We appreciate it. And I think Karl might have a special gift if you do share the show today. But enough of me talking, because you guys know I'll do it all day. Why don't we bring in Karl Schnitzer from Producers Wealth? I met Karl through one of the first responder financial freedom groups, or someone that was in that group put me in touch, said, hey, man, you're getting your pilot's license. I know this guy that's selling a plane. And I was like, okay. And then we started talking about that. And then I was like, okay, well, what do you really do? Actually, I think you sent me an email, blast email. This is why you guys should always be marketing, and said, hey, I'm now a licensed Nelson Nash, infinite bank, however the heck you say it. And I was like, dude, I've been trying to figure this out for years. Get me in touch. We went out and had lunch, and off we went. So with that being said, Karl, welcome to the show. You want to introduce everybody who you are and what you do?
Sure. What's up, guys? I almost didn't recognize you in that intro, Ian, without a beard. But so my name's Karl Schnitzer. I'm from Philadelphia. My background prior to infinite banking world and real estate world, I was actually a cop here in Philly for a few years. I was with the department for 4 years. Had some fun. That was kind of enough for me, and for many reasons that a lot of cops are experiencing, I decided to hang that up and move on into the real estate and insurance world through infinite banking.
Yeah, so I think when you say you as cops, I think first responders, government workers in general. I mean, I got to assume, and I'd be curious because we never really discussed this, but like being a fireman was like, that was it, dude. Like that's all I wanted to do. And then, we became firemen, and then very quickly you realize it was like, it's nothing more than like a social justice job. Sometimes it's like, they don't care about you. I mean, is that what you were experiencing as a cop? Like, what was your reason behind becoming a cop?
Yeah. So, I mean, I had a lot of dreams as a kid, just like a lot of cops, where, that was my goal. I wanted to go, and not necessarily with Philadelphia. That kind of just fell in my lap because of some people that I knew and obviously where I'm located. But you lose kind of like that dream and desire real quick. I mean, the academy's fun. You meet a lot of people, some lifelong friends. You go out onto the street, and it's fun for the first couple months, and then you start like your court rotations where court's coming in and you're going down to court. You're seeing what goes on behind the scenes. You're seeing the same people. It's just a revolving door get let out, and it's super unfulfilling. And then you start to see people, or, quote unquote comrades that work in the department getting locked up just for doing their job. Everyone's hands are tied, and it's just, it wasn't worth the pay to me. Cause you gotta figure in this day and age, and, a lot of cops will talk about like, oh, well, the good old times and, back in the early 90s, 80s, or even early 2000s. Well, I never experienced that. It was always, I got in 2016 to 2020, and it was always your hands were tied. I mean, everywhere you do anything you do, there's a camera watching you. And not even just to say that that's a bad thing, but every single move you make, every split second decision is scrutinized. And where I was going with that, though, is you just lose kind of faith in the mission of the department pretty easily. And once you kind of lose faith, then it's a hard job to do for, in my opinion, like little pay.
Well, here's the other thing is like we talked about it a lot. Is like I feel like Dan and I caught the tail end of something in 07 and 08, and it was like from 07 all the way to today, it was just like nothing but downhill. And I was like, wow, man, like that is insane, dude. Like it is insane what we witnessed happen. And like when you talk about, and I know this isn't real estate related, but it kind of is. Like your job as a cop or a fireman or a military or nurse or doctor is like, you got to make a decision in a split second, and you got to think about it. And a lot of times it's life or death, right? Like someone draws a gun on you, you have 2 seconds to think about it. All you know how to do is what you've been trained to do. Right. And I think a lot of people in real estate, there's no life or death, like consequence on the back end of it. So they're like, oh, I don't know what to do. And then they just mull around and then they never make a decision. Whereas I think that's actually a benefit. And I get how like you probably got stressed out about it the same way I get stressed out about it. Is like, I made a decision to drive this fire engine in a certain way to get there because I had to, because we had to do our job. But now I'm getting suspended because we were doing our job. And we could go off on a tangent, but I think it relates to real estate.
Yeah, I can completely get what you're saying. And, I think a lot of first responders make good investors because we're decision makers, where you're not going to be stuck in analysis paralysis for, 2 years analyzing 200 deals to pull the trigger on one. But like one thing you got to consider too, and it's a little bit different between police and fire, where I mean, to an extent, but like, you have your life at risk in both professions, mostly like very limited amount of the time you're actually doing something cool, but you have your life at risk. But then in policing and somewhat in fire too, you have your freedom at risk too, where you can get locked up and from being put in a situation. And that's the ultimate kind of, deal breaker to me, where like, I mean, I'll be completely honest. So we were make like 75 grand as a cop. With overtime, you might make like 90, 100, maybe a little more if you're real aggressive. But then you got to figure, okay, so let's just say 100 grand a year. You're risking your life and your freedom for 100 grand a year. And that's when my wife and I really sat down and we were like, look, is it even worth the paycheck anymore? Like, and that's where the clear answer, and I mean, to me, is no. I don't know anybody that can move on that isn't from that.
So you and your wife sit down and have this conversation. Like, what comes out of the conversation? How do you end up on real estate? How do you end up in the infinite banking world? Like, how does that whole thing transpire in a short period of time?
I had already had a bunch of properties and had done some flips when I was still a cop. I didn't let anyone at work really know what I was doing because for a lot of reasons, I didn't really want, supervisors specifically knowing that I was making outside income. Like more than, because I never took overtime details. That was never my thing. I'd rather focus on, real estate or something residual. But I had rental properties. I had flips. I had my real estate license. I did not have my insurance license when I left the department. But it got to, a point. So I left during like all the riots in 2020, and it was stupid. I mean, the amount of nonsense that was going on. And, just for an example, like my last week in the department, I remember my district, not me personally, but my district had locked up the same person 6 times within a 7-day period. And it's just a revolving door. And between that and everything else with all the riots and stuff, my wife had always wanted me to quit. She wanted me to go full-time in real estate, from the beginning, because she hated the job. But kind of like deal breaker was we actually sat down, had the conversation of like, look, let's say I quit tomorrow or in 2 weeks, I put my 2 weeks in, whatever, what happens? And we were like, look, I think I'll do better, honestly. Like, and it got to a point where I was looking at the police department as holding me back. When you got to put 40 hours a week somewhere, I felt that it was holding me back in a lot of things. I knew if I went full-time into real estate as sales and a realtor and investments, I would make more than a police salary. Like, not easily, but I could do it. No problem.
Yeah. I think that's the situation for a lot of folks, right? Like sometimes you get a little bit scared. You have that net, you have that little, cause change obviously is scary, but you have that, even if it's a small sum of money, it's like you have something that you can kind of bank on.
It's a mindset too. I mean, everybody at work thought I was like stupid for leaving a, quote unquote, safe, secure job with health benefits and a pension that, is bankrupt, but they don't want to talk about
it. That's like guys it's like walking you down to the edge of the cliff. It's like, oh no, dude, the food's over here. The food's over here. Boom. Next thing you know, you're off the cliff, right? Like I did the same thing. And Jason's heard this story 1,000 times, but I get very passionate about it. I was sitting around the kitchen table with dudes that had 30, 40 years. The one guy worked the riots in the 60s and the 2010, whatever year you want to call it, 2017, 18. I'm like, bro, what are you doing? You've worked here so effing long. Yeah. You've seen 2 sets of rides. Like, that's insane. You're leaving money on the table. More importantly, you're risking your life for what? Man, there's more to life. And Jason knows my biggest issue with quitting after everybody told me for years is, bro, just leave. Like, you're going to do so much better. And I was just too dumb. It was always, this is what I wanted to do. And it was an identity crisis for such a long period of time. But, there's also like, and I think this happens not just in the first responder world, but it also happens in the corporate world is imagine a doctor having some success, or Jason as a mortgage broker at one point, you start having success with your own business, but you're like, I don't know, man. I don't know. Like, you're not ready to go all in. And taking that dive and owning who and what you are, that you actually understand real estate, or you actually understand how to lend money on a really good basis. Like, it's hard for people to take that deep dive and say, you know what, this is who I actually am. I am not an employee. I am not a fireman, a cop, a mortgage broker, whatever it is. Like, go dive in and go dive in deep.
That's where, everyone always talks about, you got to surround yourself with the right people. And I was fortunate where I had like kind of like 2 groups where I had, my investor, business owner kind of friends, and I had my police friends. All my police friends were saying like, dude, don't quit. That's so stupid. You got a good job, blah, blah, blah. My investor friends are like, dude, what are you doing? You're wasting 40 hours a week there when you could be, building out a real estate team or a real estate portfolio. And it's completely different mindsets.
Yeah. Oh, dude, I went through the same thing, man, all the freaking time.
Oh yeah.
All the freaking time. So, I mean, dude, we could sit, dude, I know you did some real estate in some tougher areas. And then you ultimately grew into a team. Where in all this, like, you grew a real estate brokerage team, I apologize. Where in all this does like the infinite banking stuff start to come to light for you?
Yeah. So it's actually kind of like a funny story. I worked in, if anyone listening is from Philly, I worked in Fishtown, Kensington first and then Fishtown, which Kensington's a pretty bad area. It's a heroin capital of the East Coast. Fishtown is like the gentrifying kind of nicer part, which is right next to Kensington. So you have like literally $30,000 homes, and 4 blocks down the road is like a $500,000 house. And I got to see kind of like firsthand all the construction around. Like, you can't turn the corner when you're driving without crews working houses. So I started to network with kind of like flippers and investors down in that area that I saw firsthand flipping houses, and just made some contacts. I had already had a duplex at this point too, which, I thank my dad for giving me the idea to even buy a duplex. Because when I went to buy my first house, he was like, hey, you should buy a duplex. Like, you're single, or you're, don't need a lot of space, rent 1 unit out, buy the first unit. So he kind of put the bug in me at first. And then once you start collecting rent, and my cost of living was like $200-300 a month after I collected rent, I was saving a lot of money. So when the time came to actually invest money into flips or rental properties, I had the funds and I was networking with investors down there. I was learning, I worked overnight for a lot of the portion of my career there, and just took advantage, while everyone, let's see how politically correct, while they didn't do anything, I was up, reading. So, learned a lot, started making some moves with rental properties, just small, like single family stuff, couple duplexes and triplexes. That kind of all led to just kind of like go down the wormhole of real estate investing and how to acquire, more capital you have, more deals you can do. So I found infinite banking just online, looking at, how to fund deals. And I did like just some brief research on it, and I kind of tossed it aside, and I was like, this is just life insurance. It's a scam, blah, blah, blah. Well, fast forward like probably 2 years from the time I first heard about it, I'm sitting at a real estate. So before I'm even sitting there, I reached out to somebody I knew in the area through a podcast that, did infinite banking and life insurance. And he's the owner of my firm, MC. So reached out to him through his podcast, and I was like, hey, I'm interested in IBC. And he's actually designed a policy to me. And it's funny looking back at that email from like, I don't even know when it was, but then I didn't do anything with it. It sat in my email. And then I'm sitting at a real estate conference, a nationally recognized conference. And next up on stage is MC Lobsher to talk about infinite banking and how to fund real estate deals through life insurance. And I'm like, I remember sitting next to my friend Joe, and I'm like, dude, I know this guy. Like, I had an illustration from him done like 2 years ago and talked to him on the phone. And he did his whole speech. He gave a bunch of different like kind of case studies of clients he's currently working with. He had clients in the room that were talking about it. I knew some of the people in the room that were pretty big players, and they were all talking about how they use this strategy to fund a lot of their deals or really, anything. And then at the end of the speech, I talked to him in the back area, and I'm like, hey, you probably don't remember me. Like, you wrote up an illustration for me years ago, and I never did anything with it. And that just sparked a, conversation where I actually gave it the time of day. I did the research, read the books, watched the videos, the training videos, everything. I went like full force into learning it and got my policies, started using them right away, and just acquired, I used it for my flips and rentals. And, like you mentioned before, I bought a plane with the cash value of my insurance. Anything you can finance a lot of things through it. So I was doing that for a couple of years. MC came to me and said, hey, do you have any desire to get licensed and work with me on these policies? And I was like, hell yeah. I became super passionate about it. And, I was preaching to everybody before I was even selling it or coaching it. And it just kind of, worked out well, where he was looking to build out a team, and I had just left the department and had some, quote unquote free time, where it wasn't really free, but I didn't have a set schedule anymore.
Can you break down for like, let's call it like a fifth grader, what infinite banking is? Like in general, like the easiest way, like let's start with basics first.
Okay. So the easiest way that I've been able to explain it that people can grasp, and this is the same way that Nelson Nash, who's the founder of IBC, he explains it in like real basic high level terms, which is, think of the money supply in the world as the globe. So the globe is just one giant pool of water, and every river, every ocean, every sea, it's all interconnected. It's all always flowing back to this one giant pool of water. So the monetary system and how central banks work, there's one giant pool of money, and it's always flowing. It's all interconnected, and it always returns back to that one giant pool of money that's owned and controlled by the central banks. So, and when you think about it too, like, when say we go out to lunch, money would go from, my checking account to the business merchant account, goes from bank to bank. So from the pool money back to the pool money. They go out, they pay their employees. It goes from, the business bank account to the person's checking account, maybe a savings account, whatever type of account it is. It's always flowing, and it's in constant motion. So they say it has a high velocity. It's always moving. and it always returns to the one pool of money. So the idea behind infinite banking is creating that pool of money where you can use it and transact with it, but it's always flowing back to you, your family bank, your business, however it is that you structure things. And you can use the funds to buy, everyone thinks of it as like just buying assets. You can use it to buy liabilities, or, everyone's probably seen on social media all the like, hey, finance your car and pay yourself the interest, which some of that's a little bit, I understand what they're saying, but it's not technically correct. But you can use it to buy both assets and liabilities, and the money's moving, but it's returning back to your pool of money, not the central bank's pool of money. So
yeah, I think a good way, if you explain it that way, it's almost like it's your own reservoir, right? Like you have a dam and you're building up your reservoir. Sometimes it flows out into the other systems, and a lot of the time it remains in your system.
Right.
I guess
it's a way to recapture either lost opportunity cost or interest that you would have paid a lender. So there's only 3 types of ways you can spend money, no matter who you are, which is you can use cash. When you use cash, you lose the opportunity for that cash to, accrue interest for you. So if you go out and you buy a $30,000 car, that's $30,000 less that's, paying you an interest. You can finance things through a bank. So if you go to a bank, take a loan for $30,000 to buy a car, you're going to pay interest to the lender. If you finance through your own family bank, the interest, it doesn't directly credit your account and your pool of money, but it goes back to the insurance company that then pays a dividend to your account. So a lot of people say, oh, you pay yourself interest. You technically don't, but you recapture the interest that you paid.
And this is something that I've recently started to understand, and I think maybe is not explained correctly, and correct me if I'm wrong, or maybe you explain it, is that when you create a whole life insurance policy with the mutual company, you're basically almost like an equity owner into that, and they're going to pay you dividends that then allow your policy to grow, even though you might have borrowed money against it. Like, you want to explain some of how people should view this?
Yeah, I'll break that down a little bit too. So like Ian just said, the product itself, infinite banking is a strategy. The product or the vehicle that you use to implement it is high cash value whole life insurance. A lot of people get super, scared of the terms life insurance because it's not, a sexy product. It's life insurance. But a lot of people don't understand life insurance, even what it is or anything. So let's break that down first. So life insurance, everyone thinks of, okay, death benefit. If I die, my family gets a death benefit if I die. So that's the death benefit portion of a life insurance contract. There's living benefit to a life insurance contract as well. One of the living benefits is having a cash value account. Cash value account is it's a savings account on steroids, and it grows tax-free. So with that, you can then collateralize your cash value account to make purchases. But before I get into that, let me kind of break life insurance down a little more. So then you said mutual. So in the life insurance world, there's stock insurance companies, there's mutual insurance companies. A stock insurance company has stockholders. So any profit the company makes that goes to the owners in the form of a dividend, it would go to stockholders and policyholders. A mutual insurance company is fully owned by the policyholders. There is no Wall Street. There's no quarterly corrupt earnings meetings. It's fully owned by the policyholders. So any profit the company makes goes back to all the whole life holders, not just whole life, but all the permanent life insurance holders of the company. So then that kind of breaks down too. So you have term insurance and you have permanent life. Term is obviously for term. It's 10, 20, 30-year term. You're covered for that term. After that term's expired, you have to renew it. Permanent life insurance is for permanent. It's until you die. Under that kind of permanent life insurance umbrella, there's all kinds of different products there's whole life insurance, there's universal life, there's index universal life, equity universal life, variable universal life. So under the permanent life insurance umbrella, we use high cash value whole life insurance with a mutual insurance company. Very important that it's designed properly with the right product and the right carrier. I mean, some of the carriers that we use have been around for over 200 years and have consistently paid a dividend. One of our carriers, we work with Ian, it's 173 years straight. They've paid a dividend to their policyholders.
Yeah.
Go ahead, Ian, if you want, or you want me to jump in.
No, you can jump in.
So, okay. So can we break this down to, maybe a real estate transaction? Like, is this like a regular life insurance policy where, every month I'm making a premium, or am I taking one big lump sum to start it? Like, let's go through kind of that a little bit.
Sure. So it's not regular whole life. When people think of whole life, or like when Dave Ramsey talks trash on whole life, a normal whole life policy structured for death benefit won't have any cash value for like 7, even like some are 10 years. So you're not going to have a cash value. You'll have a cash value account, but there won't be any money in it. When we structure a policy for infinite banking purposes, we focus on the living benefit, not the death benefit. So we want to max out the cash account as much as we can and decrease the death benefit as much as we can up to a certain threshold. Once you hit a threshold, your policy could MEC, which is a taxable event. We don't want to ever pay taxes on it. So we have to get right to that threshold. Maybe for like numbers, it would be easy. So let's just say, somebody wants to put, I don't know, 10,000 a year in or 100,000 a year in. We structure it. It would be around 30% base premium, which is going towards your death benefit. That's your cost of insurance. 70%, or, on $100,000 premium, or let's use 10,000, maybe more relatable for people. Say you want to put, 10,000 a year into an insurance account. 3,000 of it would buy your death benefit. 7,000 of it would go into your cash value account. You can use that cash value account, and each year that policy is in effect, you're going to increase your cash value to where year 4, you're over dollar for dollar of, hey, I put 10,000 in, my cash value account increased by 10,500 or 11,000, and it's going to keep going and going. So that's how it's different than regular whole life. Regular whole life would be 10,000 buying death benefit, whereas we have 3,000 buying death benefit, 7,000 going into a cash value account.
So, okay. So I'm going to try to see if this example that I'm about to say makes sense.
Sure.
So let's say somebody is a real estate investor and they're trying to get, they already had, like, listen, if the money's got to come from somewhere to begin with, right? But so let's say they have $200,000.
Okay.
Can they create an account? Or one of these, I don't know if the term's account, that's probably not the right word, but policy. So let's say I put $200,000 into a policy. Some of that's going towards the cash value account. Some of that's going towards the death benefit, situation. Like, walk me through, if I started with $200,000, how that works, and how do I access that capital? Because I'm guessing you're getting a loan for your own money, and then you're paying back that loan. You're not taking the $200,000 back out to go buy a piece of property. So let's walk through that example.
Okay. So with 200,000 for the figure, you can put a lump sum in and then pay premiums. You have to pay premiums. Premiums are your contributions to the cash value account. You can't do like, hey, I got, $200K. I want to do one lump sum and that's it. You could, but it wouldn't all go to your premium initially. We would have to spread it out over a certain period of time, which we can do. They call it like premium deposit funds.
Is that because your dividends aren't going to be high enough to cover your premium?
No, it would be most likely that it would MEC. I mean, if we put that into a policy and we're just putting it all into cash value, it would be a taxable event. So we would have to spread it out a little bit. Normally, the minimum would be like a 5-year, like they call it like a 5-pay, where, for this scenario, say you had, 250, we would do 50,000 a year for 5 years. Now, if you wanted to go on more than a 5-year term, you could, and ideally that's the way to do it, because you don't want to have to, in 5 years, get another policy. You're always going to have cash, and you're always going to need to store cash somewhere. Well, after this policy is paid in full at year 5, you're going to have to start a new policy, and they're going to be 5 years older, and it is life insurance. So you do get underwritten. It is, they look at your health risk to the insurance company. And insurance companies, don't let it fool you. They are a for-profit company and they make a shitload of money. They have actuaries that, study this stuff and can predict, some actuaries. I listened to an interview of this one actuary, and he says that he can actually predict to the month when people will die. So they're not stupid. They're very, very smart companies. And that's why they've been around.
All right, so let's talk about this $200,000 situation.
Okay.
And then how do I even do a real estate deal with that type of situation?
So let's just say you lump sum it. So if you put 200,000 in, right off the bat, you'd have access to about 70,000 of it. So it'd be 140 within 30 days.
70%.
Correct. Yeah.
Okay.
30% is going to buy your death benefit. 70% is going to go to your cash account. In the first year, like I said, it'll grow to dollar for dollar, but you would have about 140,000 that you could access in the cash value account. Now there's two ways you can access it. The first is through a policy loan. Policy loan comes straight from the general fund of the insurance carrier. So a lot of misconception comes where, hey, you're borrowing from yourself. You're technically not. So if you have 140 over here, you're borrowing the money from the general fund. So that's why your 140 is going to continue to grow. And then you can use it. I mean, it's the easiest loan you ever get. There's no, there is interest to it. So you do pay interest, right? You can expect anywhere between like 4 to 5%, depending on the carrier. And the term of when you pay it back, that's your decision. It is, you are the quote unquote banker. So you can make terms with yourself of, hey, I'm going to not make payments on it for 6 months, and then I'll pay it back, at the sale of this property or the refi, or, hey, I'm going to make payments back over a 5-year period and pay it back that way. The loan is literally one sheet. How much do you want? Where do you want it wired to? There's no credit check. There's no reason for the loan. It's your funds. You get to do what you want with it. Then
the collateral is that if you don't pay back the loan, the insurance company is just going to pluck it from your account.
Yeah, exactly.
It's just like a loan from a regular 401k plan or something like that, right? Where typically it's not supposed to be for business use, it's supposed to be for consumer use. Like buying
and the big difference would be, between that is 401k loan. I believe the max is up to 50% of the account value, whereas with insurance, it's 90 to 100%, depending on their carrier and depending on how you take a loan. The second way too, I was just going to say real quick, that you can access the funds is through a line of credit. So there's institutions out there that will offer. I mean, if you just look at like some banks, go to their commercial lending products, they have cash value line of credit. The ones that we work with, they will allow you to access up to 100% of your account value. So using that 200,000 example, let's just say, for instance, you put 200,000 in, you got 140 accessible right now, and you establish a line of credit on that. Right now, the one carrier we use is like 3.74% for their line of credit because there's collateral. It's not an unsecured loan. And you're going to continue to grow and compound that 140 inside the policy. Plus you have this line of credit now at, let's just say 4% for easy numbers that you can then go invest into some deal and make, spread. It's an arbitrage while your original 140 is continuing to grow.
So explain how that 140 grows. You get a dividend from the insurance company?
Yeah, you get interest and dividend. The whole life insurance, which is one of the reasons we use whole life and not the other products, have a guarantee built into the policy. The insurance carrier has to, by contract, pay you whatever minimum interest they agree to. Right now, it's between 3 and 4%, depending on the carrier. And by carrier, I mean like Mass Mutual, Penn Mutual, Guardian, any of the big insurance companies, mutual insurance companies.
Go ahead, and then
I was going to say, so there's the minimum. They have to pay that. So the benefit of having that minimum is that your account will never suffer a loss. One of the biggest reasons I dislike, traditional retirement accounts for many reasons, but when you're invested in the market comes down, and every time you suffer a loss, it takes a higher gain to break even from that loss. So for easy numbers, when I like say you suffer a 50% loss, it doesn't take a 50% gain to break even. It would take 100% gain on a 50% loss to break even. And there's a chart that shows you exactly how much it takes to break even from losses. So the one of the main, attractive points of whole life is that your account will never suffer a loss. So a lot of people, and Like I talk to people all the time that are like, oh, dude, my 401k or my IRA is up, 12% this year. And I'm like, that's great, but you're down 20% last year. So you still haven't broken even yet.
Right.
And there's a lot that goes into it more than just, what people see on the surface.
So at 1.4, I know Ian wants to jump in on something real quick. So when you say guaranteed, like if I have access to that 140 and that 140 is spitting out 3 to 4% a month, like that's guaranteed in it. And is the interest guaranteed or just the principal?
The interest is guaranteed that you will collect interest on that. However, they pay a dividend on top of the interest. So right now, the dividend with our main carriers, they already elected 2023 is 5.75. So your account will grow, with the dividend and the interest of 5.75. If for whatever reason something happens and they can't pay a dividend, you're still guaranteed the 3% growth.
Right. And on top of that 5.75 dividend is tax-free.
Correct.
Okay. And then
the dividend or the dividend or the interest?
It comes over as a dividend, but both of them are tax-free, interest and dividend.
And another thing to be clear on
so it's actually 3% interest, and then it would be 2.75 dividend. The total growth.
Yeah. I mean, that's equivalent to almost double.
Yeah. It's like a 9%, in a taxable account.
Well, and I look at it this way is, all right, real life example, real talk here. In Jason's situation, the way I would view it is $140,000 goes out the door into an investment. Let's just utilize my investment vehicle because it's the simplest one to look at. We give an 8% pref. We borrow the money at 4%, right? So now we're making a 4% spread there. Then we're making that 1.75% spread above and beyond the 4% loan and the 5.75 dividend. That's tax-free. That's now another 3%. Now we're upwards of 11% in complete dividends, not to mention profit sharing. I bought into a legit asset. And that's kind of how I started to get my mind behind it was adding leverage. And the other thing is when you borrow your 140 out of the account, the 140, even though it's out of the account, is still earning 5.75%. And I think that's something that people miss. When you borrow your money out of your 401k or you borrow money from the bank, you're paying interest and you are not receiving any of the benefits of that. You own this banking system and the money's always going back to your banking system. And as you start to think about that as a way to warehouse your wealth rather than warehousing it with Bitcoin and stocks and all this other bullshit, I am warehousing my wealth here. And if I die and all the money's out, there's still death benefit paid to my family. And I know you're passionate about it and I'm starting to become more passionate about it, but there's so many moving parts to it. I think it makes it hard for people to understand it as a whole.
Yeah. So kind of the two things you hit on with that. The one, like you said, you have to keep money somewhere. So when you look at, let's compare like a couple things. We have, stock or a qualified retirement account. Depending on the type of account that's locked away for 30 years in money prison. You can't use it in a checking account. You don't collect interest. You're only safe up to 250. There's limits to that. I personally don't trust banks, and I really, for a lot of reasons, but you have to keep money somewhere. And when you look at all the different options out there, it makes the most sense where you can, like you said, warehouse your capital there and still have full use and control of it, to where when you do use it, you're not losing the opportunity cost of it. When you factor in that over your entire lifetime and multiple generations, like, Ian, we've talked with our, family office planning guy. We're not looking at 3 to 5 to 20 years into the future. Like, we're planning out 100, 200 year legacies for families of how to use this system to create, a series of trusts and reuse the death benefit for children and grandchildren, and establish that family bank where, Rockefellers, I think last article I read, they have like 200 some people that are still have access to the family bank, and they don't have to use outside institutions. They can use everything inside the family bank. When Nelson died, Nelson's the founder of Infinite Banking. I want to say he had in the 40s, it was like 41 or 43 policies or so. But he mentioned that his family hadn't seen a commercial bank in 20 years. Everything was owned and operated by the family bank.
What I want to get back to that part what you just said here in a second, but question that I think is kind of lingering is, so you put 200 in, you get access to 140 in a cash account. Explain what that other 60 goes towards. I mean, it's a death benefit of some. But...
Yeah. So the first 3 years, we call it cash drag, where you won't be dollar for dollar yet in what you've paid in premium to what your cash value account is. The reason for the cash drag is just basically the cost of insurance and the death benefit. When you factor in the life insurance company is underwriting, X amount of people, let's just say for, whatever the number, let's say they're, underwriting 1,000 people. Well, their actuaries are telling them, okay, of these 1,000 people, 30 or 40 people are going to die, and we're going to have to pay out 22 million of death benefit coverage. Well, where do they get that death benefit coverage? From the 960 people that are still alive. And that's where the first 3 years, you won't be dollar for dollar. Year 4 is when you'll see your cash value increase by your annual premium amount, and so on and so forth. When you really look at the length of the policy is where it gets attractive. I mean, we're looking at, we do a lot of policies for clients' children, and they get pretty crazy where starting policies on a children young, you can get rid of that cash drag early. And then by the time the kids are at the age where you can transfer ownership to it, they put, $2,000 in, cash value increases by 6,000 or 4,000. It's crazy, the kind of growth in the later years of the policy. They're designed to get more efficient as they go because they have to get to that death benefit threshold.
So, okay. So let's say I put 200 in, 140 and 60. The 140 is cash account, right? So if I die, that 140 stays in there.
No, so you get the death benefit, not the cash account. So if you're putting 200 in, I mean, your death benefit's going to be in several million. So, yeah. So that's the other benefit too. When you look at, comparing this to, a 401k or whatever the account is, if you pass away and you have $1 million in a 401k, your family may get, I don't know, 600,000-700,000 of that after everything. If you have $1 million in a cash value account, your family may get 7, 8, 9 million. They get the death benefit, not the cash account, and the death benefit's a multiple of the cash account.
So there's so many variations. So I know this is hard to explain. And I want to kind of walk down one of mine, but one also I just want to make this real easy for everyone to explain. I mean, I've read I've read Nelson's book, and I've watched endless YouTube videos on this, and it's unique. And I understand that. So let's say somebody's got decent amount of their own money. They have, they either buy some properties in cash or they finance some properties with a bank. Mm-hmm. Whatever, what would be, and if they're like, hey, well, I have a good thing going right now, but I'm open to trying something else. How would something be set up like that? Let's say, whatever, they got hundreds of thousands or $1 million in the bank that they buy properties with. And they also use bank loans to get fix and flip deals and rentals. Do they do, can you do one big lump sum, or do you do, like you said, $50,000 a year? Do you need multiple policies, one policy? I know it's
okay. So a couple things. Yes, you could have multiple policies. There's a minimum and a maximum built into a policy. So your minimum is that base premium. Your max is your base plus your PUA. Once that max is comfortable to you, if you're, creating value and building up more streams of income, at that point, you can't put more money into one policy above the maximum. So at that point, you would start a new policy. And that's very common in the IBC world. You'll see, people have 10, 20, some people 30 policies, depending on sizes. So yes, you will have multiple policies. Once you kind of grasp the concept and start using it and understanding it, you'll want to keep adding more policies. The other thing that you mentioned was if you had buying a house in cash. So you got to, I don't know if people ever play around with a compound interest calculator and look at the opportunity cost of some purchases where it's massive, especially like I said, we're looking at planning over multiple generations. But just for instance, let's just say, here, I got it up on my computer. If you buy a house in cash for $200,000, The opportunity cost of that over a 50-year period at 5% is $2.2 million. So that may not, the way that I look at it is if I make a large purchase in cash, I'm in essence costing my family and my legacy $2.2 million, especially, when you scale that out, because like I have, my entire estate plan and everything set up where, my death benefit goes to a trust. My trust then pays the premiums for my children and any Schnitzer born into my family. It's owned by the trust. So that policy's death benefit goes back to the trust. Big picture, looking not just in my lifetime or my children's lifetimes, but further down like the legacy line. And like the reason the Rockefellers are so rich is because they've had 300 years of compound interest working for them. And when you look at that, on top of a lot of things, they did add some value to the marketplace, but they have set up systems where they have uninterrupted compound interest working for them. And there's a big, big difference between interrupted compound interest and uninterrupted compound interest when you scale it out over 100, 200 years. And just for reference, 200,000, if you were to go buy a house for 200K in cash, the opportunity cost of that over a 200-year period, which could be, maybe 5 generations, is 3.4 billion is what you're costing your great grandkids, or however you want to look at it.
Sure. Yeah, no, that's interesting. That's interesting. Yeah, I think the hardest part for a lot of folks is just kind of understanding.
Yeah,
I think the benefits make sense. What you just said, like,
yeah,
it's kind of
but you mentioned too. So how do you know how much? We always recommend to clients. So when people come to us, we like them to come with a foundational, knowledge. If they don't understand what it is, we'll send, a bunch of resources, videos, books, everything. But we don't want people just, signing up blindly and then they're pissed off when, they have 70% of their cash value year one. We're like, dude, this is, we told you this is how it works. But regardless, what I'm saying, when people say, how much should I do? No situation's the same. So we like to look at, everyone's personal situation, but we would recommend minimum like 10% of your income. That's just a general savings rate. And it's just a matter of where do you save the money? From there we can look at, okay, well, I have, 40, 50K in this account. Well, then that's when we could structure like a year one lump sum of X amount of dollars. And then this premium, that will, we do that fairly often.
So on most of these plans, the contribution is shorter term or longer term.
We structure these to be paid out at age 70 for the most part, unless like some scenarios are different. Like if someone just got a inheritance of, like I know one policy particularly I'm thinking of, they inherited $2.5 million, which, that's nice. But what we did was structure that to go into $500,000 per year for 5 years. That they didn't really have other income after that. Like we're not going to structure it at $250 a year until age 70 because they only have $2.5 million.
Why is that better than doing one lump sum? Just out of curiosity, if they had the money,
like the full $2.5 million, you wouldn't be able to. So there is an annual max of $500,000 per year is like IRS codes max you're allowed to put in 1 year. But even so, we would want a minimum of like 5-year term. Anything less than that, your policy would be on the verge of mecking most likely.
So let's just say it's a 5-year term. And then after the policy is in place, you just can't contribute to it, but it's going to continue to grow.
Yeah, and it's paid up. So
yeah,
these policies, it's kind of like, so some insurance agents will use the analogy of a house where you're making mortgage payments and part of it's going to equity, part of it's going to, the cost, the interest. And at some point that house is going to be paid up and paid in full. Well, it's the same with a whole life insurance contract. At some point it's going to be paid up in full. It's just a matter of where we make that to. And we like to make it as far out as possible because you're always going to have money and you're always going to have cash to put it somewhere. The policies are self-sustaining after like year 11 is when the dividend covers the full base premium. So at that point, it's like, okay, I don't have to pay my premium this year because I can just elect the dividends to pay my premium and I could build up another policy over here.
So do most high net worth individuals that really understand and live this? I mean,
100%.
they use this as Like
funny.
they're checking and say they use this as their savings account, right? Like they
absolutely.
create premiums because they're not putting whatever, even if it's $100,000. Let's say they're really high net worth and they only have $100,000 or whatever.
Yeah.
Or I'm sorry, and they like every dollar is just going back into these policies.
What I kind of tell a lot of people, and don't look at, and I'm not saying don't look in general, but don't just be looking at what the 0 to 1, 2, 3, 4, 5 million guys are doing. Look at what the 20, 30, 50 million plus families are doing and have been doing for the last century. And a lot of it you'll see, like in the family office space, this is used by far probably one of the most popular products. And we see it all the time. And Ian knows one of our partners that he builds family offices for people. And in the last 20 years that he's been doing that, he has these super, super high net worth families that come to him and they establish a family office, which is basically a board of directors of, CPAs, accountants, things like that, all kinds of different advisors. And he sees the balance sheet of all these families for the last 20 years. And he it's fun having a conversation with him because he will tell you, he's like, dude, you don't see 401ks, you don't see IRAs, you see real estate, you see businesses, and you see life insurance.
Yeah, dude, I think that's really important. And that's what, if you can mentally get around the idea of moving your money away from the traditional banks, storing and warehousing your wealth inside these policies, which is a commitment, right? Like that's what I'm working on, is creating this commitment to getting more money into these policies over a long period of time. That long run, not only will I have the benefit, but my successors will have a benefit above and beyond. And one of the things, and another time we'll have Steve on from the family offices, that sometimes these policies can pay some of the inheritance tax and some other things that might happen as you start to go away. So these policies become very, very powerful. I think there's so many moving parts. People get inundated. And like you said, oh, well, it's only 10 grand a year in, right? You make 100 grand, you save 10 grand. People are like, well, that's not shit. Everybody wants the fast cash. But Jason and I both know is, everything that everybody sees from us is 10 and 15 years of grinding it out every single day, the same way that your personal finances are a grind to get them to, all right, after 20, 30 years of doing the right thing, that this is going to pay off. And most people don't want to be patient and wait for it. But I will say the same thing is, like, I put a lump sum in and borrowed the money back out right away. Not suggested, but it happens because I want to get the policies open to then be able to utilize them at a later date. I'm a little cash constrained on a few things. So put the money in, get it right back out, and keep the ball rolling.
That's the thing too. And what I kind of encourage people, like infinite banking or life insurance, it's not an either or option. Like, hey, it's life insurance or real estate, life insurance or stocks, life insurance or crypto, whatever your niche is. There, it's both. It's life insurance and real estate, life insurance and crypto. You can do both. There's actually a book called, and he's a competitor in the space, but I'll give credit where credit's due. There's a book called The And Asset, and it's a life insurance book on the and asset, how to use life insurance and whatever asset it is that you're buying.
Yeah. So no, go ahead, Ian. I was gonna say, like, what are next steps for some folks in order to just get more information in general?
So
because this is probably a really new, like.
So there's a ton of content. There's a ton of content out there. What I would recommend, every single life insurance agent out there will tell you they know how to design these policies. And that's where Nelson Nash created the Nelson Nash Institute, which you can go on there and find an authorized practitioner. A lot of them that you find, like, myself and our firm, it's not hard to get your license in every state once you get one. They're all reciprocal. So a lot of authorized Nelson Nash Institute agents are licensed across all 50 states. But I would start there for info. And then from there, kind of, you can go into like the YouTube, rabbit hole space. But you got to be careful of who you get info from, because not everybody out there is a Nelson Nash advisor or authorized practitioner, they call it. And I would really be cautious about who you get your info from, because there's a lot of people selling the wrong product for infinite banking. And, I can tell you as a authorized IBC practitioner, I would lose my license if I sold certain products that people out there are selling for infinite banking. But then for education too, we can do my little giveaway on podcasts. Any podcast I'm on, what I like to do is for the first, we'll do 3 people that can leave you guys a review, share the episode, tell, Ian or Jason, shoot them an email or however you guys contact your listeners, who the first 3 people are. And what I'll do is I'll mail a copy of Becoming Your Own Banker.
Sweet.
Out. So this is like the quote unquote Bible of infinite banking. Nelson has written many books. This is kind of like the one that gets people thinking differently he says in the book, you got to unthink your thinking. And this is the book that, helps you do that.
Yeah, you definitely. I actually have read it twice now, and probably going to read it again. Sitting down with you actually helped a lot. And this isn't a sales pitch because it's not what we do. But if you sit down with the right person and start to understand it, and again, those that are usually utilizing it are so excited about it because it's like the wealth unlocking tool. Sometimes people are like, "Holy shit! Why did I not think about like this before?" Yeah, it's super powerful. So
what's crazy too. Whole life used to, like, if you talk to maybe your grandparents or depending on the listeners' ages, whole life used to be the number one way people would stash their savings account or plan for retirement, because you can structure retirement income out of these policies. But it wasn't up until like after World War II and when Wall Street had to get their hands into everything until things started to fade away from whole life. And that's where even universal life stuff too. I mean, that's a fairly new product, came out in the 80s. And, the reason is because Wall Street needed to get their hands on more capital. So they created a life insurance product. But the whole life product itself was actually very, very popular for savings and for retirement back in the day. There's nothing new about it.
Yep, 100%. Yeah, dude, it's definitely eye-opening, and you start going down this wormhole. It might challenge you on some political beliefs and everything else in between, and then you can come and visit me and Karl, because I know Jason's in the Howard County bubble and won't let me talk about politics.
I'm down the rabbit hole of
conspiracy,
anti-Wall Street, a lot of things in finance.
Yeah, right on. So obviously Nelson Nash is Become Your Own Banker is probably your number one book. Thank you for being willing to give that out to anyone who shares it. But
I'll leave a link too. You guys can leave it in the description, but if you go to it's theproducersbank.com, that is the landing page of the video that we use that we like clients to go to, and we break down everything pretty simple so that when they do come to us for a consultation or a strategy call, we're not like re-explaining everything. We're kind of can have, productive call of, okay, you understand the basics of it. Here's kind of the details, the nitty gritty, and we can kind of have a more productive call. So between that and some other videos I can share.
Okay. So when you're not doing infinite wealth stuff, what's your favorite book or podcast that you like to listen to that would be a good share to the audience?
So podcasts, I'm big into like Ed Milet's show. I like, I'm kind of biased too because I'm friends and work with him, but MC Lobster's podcast is awesome. Cash Flow Ninja. He has some really, really cool guests on there. I like that show because it's not just finance. I kind of got bored of just listening to like real estate after real estate after real estate. And he brings people on that are, economists and just people that can look at, all the different markets as a whole. And, I trust a lot of the opinion and the statements of him. So when he's having these conversations, it's like things that I would have wanted to ask anyway. But like I said, I'm kind of biased to recommend him because he's a friend. But his podcast is awesome. Ed Milet. What do I listen to? Bunch of different. You guys.
I mean, there's so much to choose, but I mean, just saying you listen to Ed Milet, right? Like, great motivator.
Oh yeah,
his podcast is good because he covers everything from finance to politics and everything in between. But yeah, dude, it's, there's a lot of good stuff out there. What's the best way people can find you if they want to reach out to you more about setting up an infinite banking policy or just trying to get out of the rat race and, find out how you did it?
Email is best. I'm pretty active on social media too, so I'll send you guys my media platforms you can put in the description. But real quick, my Facebook is just Karl Schnitzer. My Instagram is Schnitz93, SCHNITZ. Email is schnitzer93@gmail.com. Website's producerswealth.com. We can, I'm sure you guys can leave links to everything, but email's probably the best to reach out to me. I'm on top of that. Pretty good. And I can, anyone that is interested too. And, maybe you don't want a policy, be like, hey, this was interesting. I have like templated emails I can send out of like lists of, okay, hey, these are really good books. These are good YouTube videos. Here's some of our own videos. Here's a documentary on Nelson Nash. Here's, a bunch of good stuff that I would want to see if I was just introduced to the topic.
Awesome. Hell yeah. No, man, we definitely appreciate that. There's a lot of good stuff out there, not only from what you're providing, but there's a ton of great case studies if you dig around on YouTube, assuming you find the right people, and go from there, man. So appreciate it. Look forward to having you potentially, at our next event. And I think more people need to explore this. Real estate investors. For what it's worth, I'd say like probably 80, maybe 70% of our clients are real estate investors, and they use our policies to acquire more real estate. They're mostly, we work with a lot of business owners, but a lot of them are real estate investors too.
It's cool. It's interesting. I think, if everyone's listening to this for the first time, wrap your brain around it a little bit.
Blown, yeah,
exactly. And then do like Karl said, like do some research, Google it, listen to Nelson's book or read Nelson's book, start with that. And then, see if you can wrap your brain around, because my brain's close. I'm close. I haven't done it. Yeah. I've been wanting to do it. I need to push a little bit. And I think I got a little bit more clarity today.
Yeah, definitely. I mean, it's like you said, it's not a normal topic or one that's, super easy to understand. So it does take, a level of research on your own part. And when you're doing your research, I mean, there's all kinds of information out there, good and bad. And what I would say is to a lot of people, look at everything with an open mind. Most of the people that say bad things about it, you're either taking business away from them because they may work with Wall Street, or they have no idea what, life insurance even is. So, there's videos of certain people out there that get around that, just like when I, as a life insurance agent, see it, I'm like, dude, that's not even accurate or correct. Like, that's not how a life insurance policy works.
Yeah, no, makes sense. All right, Karl. Well, we certainly appreciate it. And thanks for tuning in to the Real Estate Reserve podcast. And we'll see everybody next week.
Thanks for tuning in to the Real Estate Reserve podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too.